Good morning, everyone, and thank you for joining me. This is the Morning Market Review. My name is Russell, Senior Market Specialist at FXCM. My email address is r@fxcm.com. Today is Thursday, the 1st of September 2022, and I'm going to go ahead and bring up the high-risk investment warning. I'll keep this on screen for a few moments. And then we will discuss very, very interesting developments which have a direct bearing on what we're talking about yesterday, right? So here's our market commentaries disclaimer. Just keep this on screen for reference. I'm just going to mute for a moment. I feel a cough. I beg your pardon. Okay, just want to check that I've got the right screen on. Yeah, okay, cool. And here's our references, market scope. We're still going to use NBC today. Sorry, I've got to see if I can find another website with a more comprehensive morning note. But we'll use CNBC today, and then TradingView. So I'll put on TradingView here, and we'll talk about this in a moment. Let's just get through the CNBC. Okay, cool. Kubus, good morning. Nice to be in the webinar, and he's just asking for the NFP link for tomorrow, which I actually do have. I'm going to just pop it into the chat. So we're doing the live trade on non-farm payroll tomorrow. I've just posted that link in the chat there, Kubus. So go ahead and click on that. If there's any issues, you guys can just email me. Let's just go through the CNBC, well, they call it now the live update. So let's go through that. It reads, European markets set to start September on a negative note. And the article, European markets are set for a negative start to the new trading month, having closed out August lower as traders grapple with fears of higher interest rates and a looming economic downturn. Market jitters have been prevalent since Friday after hawkish remarks from Federal Reserve Chair Jerome Powell. On Tuesday, New York Fed President John Williams called for a somewhat restrictive policy to slow demand. US stocks fell for a fourth straight day on Wednesday, the last trading session for August, putting the summer market comeback in doubt as investors weighed the Federal Reserve's inflation-fighting efforts. Meanwhile, shares in the Asia Pacific are trading lower Thursday as investors digested the result of a private survey on China's factory activity, which showed the sector slipping into contraction this month. US stock futures fell slightly on Wednesday night. Okay, so that's the article. Let's take a look at this real interest rate, which is a completely different chart than it was just 24 hours ago. 24 hours ago, there was hardly any movement on the real rate. And I was suggesting, well, why is there no movement on the real rate, considering the hawkish tone coming out of Jackson Hole? And, well, the real rates moved very quickly to prove me wrong. So you can see that we have pushed right up into the bullish area. The bullish area being between the upper red and upper blue, and it's a very strong candle. If we take a look at the daily, that's where the movement was. Look at yesterday's movement. Pow! You know, it's quite quite amazing. As soon as I make the observation, well, interest rates don't seem to be doing much. You know, bang! That's almost as if somebody was waiting for that. And you can see that there's a big movement up, and that's the environment that we are in. Okay, so whatever hypotheses I had, I think need to be reworked because the interest rates are on the move. And what we have here is real rates in the top chart. What we have in the lower chart is actually gold. Okay, so isn't that interesting? Here's gold, and then we've got the correlation coefficient of real interest rates to gold. Now, this dashed vertical, that's when real rates turn positive. This this blue horizontal here, that's 0. Okay, so anything above that 0 line is when the rates have turned positive. And what's quite interesting, of course, is as soon as the real rates turn positive, that's really when gold effectively comes under pressure. There's an obvious decline once we turn positive in the rates. So from there to there, you can see it's a fair amount of pressure that's been applied to the precious metal. I mean, that's as the real rates have been positive. And the real rates have kind of sort of kicked sand in my face, and they've started asserting themselves again. And that we can't ignore. Okay, so the real rates have moved into zone 1, and as Anna suggested yesterday, Bollinger's tightening, right? Bollinger's tightening. So that now is something that we want to keep an eye on, right? Because if there is an expansion in those Bollingers and the real rate remains in that zone 1, well, that's real rates moving up. And if real rates are moving up, there is going to be a natural flow-on effect, a natural ripple effect. By the way, Rob, this probably also fits in with that very last comment that we spoke about yesterday, which is, of course, the QT, right? What's going to happen with the QT? So now we're in September. This is when QT is meant to normalize. What do I mean normalize? We're talking 95 billion of assets being sold off by the Reserve Bank on a monthly basis. Whether they hit the 95 or not remains to be seen. We've got to see, because I was under the impression they weren't going to hit that 95, but regardless, they are making a concerted effort to get to that 95 billion. 35 billion is going to be mortgage-backed securities, those are longer term, and then the 60 billion would be treasuries. And that in of itself, one would expect will have an impact on yields. And then the obvious question is, well, is that what we've seen here? Considering that we had the 31st of August into the 1st of September, is that what's been reflected here? So very much keeping in line with, I think, the hypothesis that we're building. It's a little bit hodgepodge at the moment, unfortunately, but perhaps getting a little bit clearer. And we want to just see the ripple effects of real rates. So the first ripple effect is that gold is under pressure. Let's just try and put a fundamental sort of reason to what could possibly be pressuring gold here. And I think it comes to, I think we can make 2 points. I think we can make two points. The first point is that in this uncertain environment, given the real pressure on returns, the market's preferring a real return over a potential capital return from gold. In other words, no matter how small the return, it's better than losing money, right? So we've got a tiny 0.72%, and let's be clear, it's not. If we had to add in headline inflation, there's no ways that this would actually be a real return. But you're kind of trying to minimize the damage there, right? So that could be one reason. And the second reason, of course, is I think there's a dollar effect, because, of course, 1 per ounce measured in dollars. So let's go through to the dollar and take a look at it from that point of view. And we will look at the correlation coefficients. Let's just mention the correlation coefficient here, by the way, just before we go through to dollar. So what's interesting for me in terms of the correlation coefficient, I think there is a obvious movement of once we hit real. Okay, once we hit positive on the real side, the correlation coefficient rolls over and becomes negative. So I think that the real rate there makes a huge difference. Let's go through to the US dollar. Okay, so let's bring up the FXCM US dollar basket, and we're going to also take a look at the correlation coefficient for that. Okay, and what we have here is clearly a very strong relationship between real rates and the US dollar. And in fact, I don't think the appropriate appropriate locking up of the two in terms of their correlation coefficient is on the 25th. I think the 25th probably works quite well with gold, because that's when I think the market sees we go positive. But I would suggest maybe a month back, around about this date, the 14th, is really where the dollar starts getting interesting in terms of the rates, and that's because this is the week where that QT is effectively confirmed. By the way, you can probably make an argument that gold starts feeling the pinch there as well, but regardless, I think the point is that real rates are on the move, that the dollar is strongly positively correlated. I think that in and of itself is hurting gold. Moreover, I think that gold is perhaps becoming secondary to an actual real return, even if it's a tiny real return. And that's kind of the environment we're in, which I think says that if you think about it, the real rate's 0.5%. So and when I say the real rate, you know, there's a debate there, because it's not really a positive return when you add in the when you consider the headline inflation, right? So, but the sort of fund managers or the market participants taking the best that they can get at the moment. And if that's the case, let's go back to the headline, which read European market set to start September on a negative note. So let's bring in DAX now underneath the real rate. We're using the real rate here as a proxy for just general movement of rates. I think it makes sense, by the way, and the reason for that is because ECB is fighting serious inflation. Yesterday we came in, I think, at 9.1%, which was above. I think 9% was the forecast. 9.1 came in. So I think ECB is moving rates. UK, there are reports of really unbelievable inflation numbers by year end. So the BOE has a job on its hand as well. So I think sort of using this real rate as a proxy, as an element, just to as a yardstick, is okay. Okay, it might not be the exact regional numbers, but I think it's sort of the trend will be similar. So with that said and done, let's bring in the DAX underneath. Alrighty, and let's throw in the correlation coefficient here as well. By the way, is everyone comfortable with the correlation coefficient? If you're not, I'll just run through the theory. I really like the correlation coefficient as an added sort of view of what's happening. So I'll just run through the theory in a moment. It's quite straightforward. All right, so let's just take a look here. All right, so let's go back to we'll use the 14th. So this is where the Fed announces QT. The DAX remains under pressure. Okay, the DAX remains under pressure. So we're going back to the 14th of March, And in fact, I think we can probably go here to the 28th of Feb. Of course, this is the volatility from the Russian invasion of Ukraine. So the Russian invasion of Ukraine here really rattles the DAX. It actually rattles real rates as well, which makes sense, okay? But then the real rates get that boost from that QT. But the risk premium that has emerged out of the conflict of the sort of Russian aggression into Ukraine remains. So let's just take a look at two important sort of fundamental aspects here, which I think are going to help us make sense of what we're seeing here. So I'm going to just bring up Microsoft Paint. So the first is probably, I don't know if it's a fundamental aspect. I just want to run through the correlation coefficient with everyone. I just want everyone to be very comfortable with the correlation coefficient. It's a very important, not important, a very useful way of building the portfolio. So you've got boundaries in a correlation coefficient. The boundaries would be 1 and -1. Okay, those are your boundaries. And then clearly in the middle, you've got 0. So we just got to understand what's happening at 1, 0, and -1. Once we understand that, it becomes very useful. So 1, so it's what a correlation coefficient is doing. It's measuring two instruments, and it's measuring how close they move in step to each other. So if they're both moving sort of completely in step with one another, that's 1. That's called a perfect correlation. Think about it as a 100% similarity between the two. Okay, in terms of movement, right? If you've got the two instruments that are moving exactly the same but in opposite directions, then it's -1. That's a perfect inverse or negative relationship. Now there's 2 points to be made. If you have a portfolio of -1, you're not going to get anywhere, okay? Because there's no risk. As soon as you've got no risk, as soon as you've assumed no risk, there's no chance of reward. So if you go long, so let's just say you buy one instrument, and let's just say you short the exact same instrument. Let's take costs and brokerage out of the equation. So let's just say you go long the US dollar and you go short the US dollar in exactly the same proportion. Well, you're going to have effectively a 0 return, because as your one position moves up, the other one's going to move in exactly the same proportion down, giving you a net 0. So if you've got a -1 here, then you're not going to get anywhere. If you've got let's just say you buy an instrument. Let's just say it's very difficult to find. Let's just say you buy the FXCM's US dollar basket. Let's just say you buy the FXCM US dollar basket, and let's just say you buy the DXY, which is the trade weighted dollar. Whilst they're not exactly the same, they're going to give you a portfolio correlation close to 1. Well, you may as well have just bought 2 lots of either the US dollar basket, or you may as well have just bought 2 lots of the DXY, because one of each not giving you any diversification. It means if the dollar moves strongly, you're going to move very strongly, but if it moves negatively, you're going to lose quite strongly as well, right? That's because you are sitting at 1. What's interesting is if you can build a portfolio at 0, well, then you actually get the benefits of diversification, because the movements will be independent of one another. It means as one goes down, one might go up, and vice versa. And if you start adding 3, 4, 5, 6 instruments, the actual risk moves down. And there's been studies to about there's various studies, but sort of between 12 and 18 instruments provides optimal diversification according to one study. And I think another study actually was much higher, at around about 30 instruments. But the point is, you want to try and get your correlation as close to 0 as possible. So that's the first thing we want to tackle. The second thing we want to tackle is what we've seen on this chart, because there's actually two two elements that we're seeing on this chart. And if we understand, we can actually trade the indices in a much more efficient way. Okay, so the first thing we've got to know is we've got the interest rate. Okay. Sorry, I just want to get rid of this. We've got the interest rate. Okay, what we're going to call that is all right, we'll actually do it. I beg your pardon. I don't want to confuse you too much, but I want to do it 100% correct. I'm going to just change the. I'm going to just change the real rate. I'm just going to use US 10. I'll tell you why in a moment. I'm just going to change it like this. Okay. Okay. We'll just use that. All right. So there's two elements here. So we changed it from what's called the break-even. I beg your pardon. We changed it for what's called the real rate. I've changed it to the nominal rate, and that's actually because Anna again introduced. Well, is the real rate the risk-free rate? And the answer to that was no, it's not. The nominal rate is the risk-free rate. Okay. In other words, what we have done here, let's just make sure, is we've got nominal, watch this very carefully, nominal, okay, equals, here's what we have in, we call it the real, and that's what we've been looking at, and I think a lot of focus should be on the real, but then we're just going to add in an inflation adjustment because we need to be compensated for inflation. Okay, so that's the risk-free rate. And then we're going to add in something called a market risk premium. Market risk premium. In other words, what is the market risk premium? You've got a choice, okay? You've got a choice. Right now, you guys can either take your money and you can deposit it into a savings account, and you can earn pretty close to the nominal interest rate. It's going to be risk-free, pretty much risk-free. Okay, I mean, you have to search far and wide to find a bank nowadays that's going to go under. So you'll find so that's the one thing you can do. The second thing you can do is you can take your money and you can actually buy a security on the stock market, or you can invest in a managed fund, or you can do anything that is market related. But now you're assuming a risk because the market can go down, right? So all of us will say, well, we will go into the market assuming that we earn, or we have the potential to earn more than what we can get in the bank. Otherwise, why would we do it? Well, if we can't get more than what we can receive in a savings account, why would we go into the stock market? It wouldn't be appropriate. So we would need a premium. Okay, so now we've got, okay, let's call it the total rate. Okay, let's just call it the total rate. So you've got then what's called nominal. So we need to get at least nominal, and we need some sort of premium. Otherwise, we're going to go into we'll just put our stuff into the bank. Okay, so now that we've got a total rate here, it makes a lot of sense what's going on with DAX. So DAX, okay, so DAX has got an exposure to the real rate. It's got an exposure to the inflation adjustment, okay, and it's got an exposure to any market risk premium. So what's effectively happening is we can see that the market is moving up. I beg your pardon. We can see that the nominal rate is moving up. Let's just go back. Let's just go back here. So look what's happening here. Nominal rate is moving up. Okay, I think everyone would agree with that. We can see it. It's in the top chart. It's moving in that northeasterly direction. Now, what about the risk premium? Is that moving up or is that moving down? And that actually becomes a little bit ambiguous, okay? That becomes ambiguous. So I'll ask you guys, okay, because everyone here would have a view. If you have to invest in the DAX today than you had to do, let's say, a month ago, do you think it's more or less risky? If you think it's more risky, then the risk premium, your particular risk premium, is moving up. You want more money for assuming more risk, or more reward for assuming more risk. So the key here is the direction of your market risk premium. And it seems to suggest, we seem to suggest that we're in a very uncertain time. Uncertainty equals risk. If uncertainty is higher now than it was before Jackson Hole, risk premiums must be moving up. So, okay, we've got total rate equals nominal, okay? We know nominal is moving up, we can see it, okay? So total rate would be moving up based on nominal. What about the risk premium? Well, it's probably moving up as well, given the rhetoric out of Jackson Hole. So we've got these two components of total rate taking us up. Now, with all that said and done, okay, because this is probably sort of, you know, enough. It's enough. We get where you're going, Russ. Then we go back to the time value of money calculation, which is what we said yesterday. So we would go present value equals, and we just use cash flow. We'll just use cash flow, which we're going to assume is a constant, just for the sake of this conversation. But as Rob said, mentioned yesterday, highly unlikely. Not that it's highly unlikely. It's not. It's not. Cash flow won't be constant, but we're going to just assume it's constant, okay? Because I think it's going to make the point 1 plus, and we'll just put total rate, okay? Now, this is the key. Total rate's moving up, okay? Well, then the time value of money is telling us that the denominator is moving up. Well, if the denominator is moving up, then there is pressure on present values. And that's what's happening in the market right now. That's what. So how do we trade this? All of this seems very, very theoretical. Well, the idea is to form some sense of what's happening with the rates. Okay, Anna, cool. Speak to you tomorrow. So we've got to get some sense of what's happening with the nominal, okay, which we can see is moving up, and we've got to get a sense of what's happening with our risk premiums. Once we can get that, we'll get an idea of what's happening with the total rate, and then we can go back to our DAX, and we can actually understand now why DAX is starting to fall back from the zone 1, is starting to fall back into zone 3. And that is because there is adjustments taking place in our total rates. Okay, the actual phrase for real rate is what we call the discount rate. Okay, so when your discount rate is in flux, your present value is in flux. So you can see here that the market, when we start discounting the available information, and we're discounting every moment of every day, okay, the present value is changing. So if there is some sort of news that comes out that adjusts the risk premium downwards, well, that should support the present value. If there's any news that suggests that the real rate or the nominal rate is going to come down, that should support present values, and vice versa. So now that we sort of have the fundamentals, we can start looking at the DAX. Going back to the headline, European markets set to start September on a negative note. So we go through to our weekly, and here we can see peak, trough, lower peak, lower trough, lower peak. Now we're in the midst of this swing here. Okay, this is a weekly, we're in the midst of the swing here. I've got lower trough question mark because it hasn't taken out this guy yet. But okay, we're in the midst of the swing. Where it ends, we don't know. But if it carries on in this trajectory, we'll get the lower trough. And just before we get to the daily chart, which is the next part of our analysis, what I want everyone to do is just take a look at this candle here, which is a remarkable candle, isn't it? What's happened here is that the bulls effectively took price all the way up to the high for the week. So at the high of the week, that is where something remarkable happens. The bulls lose control, and the bears take over. And the bears are absolutely vicious now, rampant, in that they've pushed price actually below where we opened for the week. And the question is, well, why did the bulls lose control? Why did the bears take over? And that's because there's been some sort of adjustment in the risk premium. And I would suggest that the adjustment in the not the risk premium, I beg your pardon, adjustment in the discount rate. And I would suggest that the adjustment has typically taken place on the real rate side. So that's pushed the DAX down, and that's why we have a very, very interesting candle here where the bulls now have lost total control. Well, if the bulls have lost total control on the weekly, what's the daily showing us? And the daily showing us quite a bearish scenario here. So we traversing in the lower channel, which is the lower blue, lower red. And what's interesting here is that the Bollinger's have shown expansion in volatility. So we're getting that volatility break to the downside, and the momentum is under 20. The longer we stay under 20, well, then the closer we get to getting this lower trough charted. So DAX in a very weak place as we start September. Now, given that there does seem to be an adjustment taking place on the discount rate, and given the fact that the bulls have lost control on the weekly, given the fact that the daily is showing signs of weekly, let's go down to the hourly. And here is where, let's just take these out because they're old. This is where we can try and get our timing. So let's go and put in let's put in some sort of pulse or heartbeat. Okay. And well, clearly we can see that the S1 is acting as some sort of support. And not only is S1 acting as some sort of support, there does seem to be a confluence over here. So the S1 level is a key level of support. How do we approach this? Let's just go back to the factors that seem to be driving the market. Number one, discount factor has increased. Okay, so there's pressure on the present value. Weekly, the bulls have lost control, bears have taken over. Daily, we're in zone 3, downside momentum. Any sort of rally from this type of position then would be suspicious until proven otherwise, right? So some sort of rally to the central pivot or to the R1 here certainly would be, I think, watched by market bears very carefully. And if there is any sort of movement towards the pivot resistance or the R1 resistance, I would look to see if there's any opportunity to move in the direction of the higher discount rate, in the direction of the weekly candle deterioration, in the direction of the daily downside momentum. So the rallies here are going to be very compelling. There is one more thing just to mention here. So I'm going to just go and mute again. I can feel a cough coming. I beg your pardon. Is that if there's no rally, and if there is sort of a breakdown of S1, you've got to make the choice if you want to get involved with that or not. Personally, sort of I look for a sort of a rally. So I haven't got a position in DAX, but the hourly momentum is weak. In other words, if it stays in this lower quintile, if it stays in the lower quintile, we've got a real chance of developing the current swing. I don't know if that's going to happen. It all depends on whether this R1 holds or folds. So that's just something to keep an eye out for. If it holds, of course, and there is some sort of rally, I think that becomes quite compelling. All right. With that all said, are there any questions? Are there any questions? Okay, so just want to remind everyone we've got the live trade tomorrow, and we'll trade the euro US dollar again. What we'll do is we'll wrap up here, and if there are any questions, you can email me. With that all said, I want to wish everyone a good day ahead, a good evening ahead, and we shall chat tomorrow. Thanks, guys. Cheers.